Tip number 7 to protect yourself against an unexpected volatility spike is to use broken wing butterfly options. So this is what the UVXY looks like for the last year or so. Now I would imagine there's several people out there thinking that if they short it here and the Iran war is resolved pretty soon, that they could make a nice profit. The problem is if the war did get worse in the next week or two, the UVXY could easily double or triple. But if we go to the Analyze tab, I'm going to use this one for 13 days out, and I go over here to the put side and I buy a butterfly for the 44 strike like this. This is what that trade looks like. Now it's a tiny narrow sliver, so I'm going to adjust these strikes, 48 on the high side and 40 on the low side. This is a standard butterfly option. We can see the UVXY traded right there around 51. And our general expectation is that over the next week or two, the UVXY will go down, which will likely move it right into our profit range, which is what we're looking for. It's also very important that we use defined risk trades where we've capped our maximum loss. Remember, the UVXY will probably go down, but it could also go much higher, and we don't want to take excessive losses if that happens. So the max loss in this case is about $68 on both sides, but the maximum gain is $332. So on its own, that butterfly is a great risk-reward ratio. You're betting a small amount of money to potentially make a lot more. But we can do even better than that. So we can take this standard butterfly option and turn it into a broken wing butterfly instead. That's very easy to do. I can just take this 40 strike and put it at 38. I'll just adjust these break evens a little bit, and you can see what I've done is I've essentially taken some of the risk from the high side and I've moved it down to the low side. That broken wing butterfly transfers risk from one side to the other, and it means that the only risk to a losing trade now is if the market bounces very strongly. But another built-in benefit here is that most people have a portfolio that is already net long the stock market. If the war was resolved and we saw a bounce here where the UVXY went down a lot further than we were expecting, most people wouldn't care because the bulk of their portfolio would have made a nice return when that rebound happened anyway. We're essentially shifting the risk towards where we care the least about it, and we're shifting risk away from where we care the most about it.